Hello, my name is Jacob Newton. This is my research project on volume as a trend indicator for future stock prices. The area of research is outlined in my topic statement as follows. In highly volatile stocks, relatively large spikes in volume occurring in joint with relatively small price increases will indicate a further upwards trend in stock price. The image here shows the performance of Cenovus Energy Incorporated. This is one of the stocks analyzed in this study, and the image here shows the volume and price overlays for a single trading day. To help narrow the seemingly infinite amount of stocks to be analyzed, some criteria was put in place. To be considered for analysis in this research, a stock must possess a high beta value. Beta is a measure of volatility of an equity with respect to the entire market. A beta of 1 implies a stock will fluctuate in price at a similar rate to the market as a whole. A stock with a beta rating of 1.3 is expected to be 30% more volatile than the market. In this study, stocks with beta ratings greater than 1.5 are being considered. This will greaten the chance of large price and volume swings in a short time period. The other piece of criteria required for a stock to be considered for analysis is that the company must be of sound economic standing. Financially stable companies with sound revenue streams and fairly reasonable chance of survival are ideal for this study's purposes. The criterion limits the possibility that the company may go bankrupt at any given time, causing a significant price crash and deviating from anticipated trends. In order for a company to be considered sound and healthy, the Morningstar rating is being used. Morningstar provides ratings from 0 to 5 stars based on a plethora of criteria and in-depth research. In this study, the minimum Morningstar rating a stock must have to be analyzed is 2 stars. Here's a list of the stocks analyzed in this study. Included along with the company trading symbol is basic information such as beta, Morningstar rating, market capitalization, and sector. All of these companies trade on the Toronto Stock Exchange. The method used to identify incoming trends was developed as follows. F of t is the volume function with respect to time. Let t represent the initial position, let beta represent the step size, and let n represent the number of timestamps. Should volume increase between 2 consecutive timestamps, epsilon will be equal to this change in volume. We want epsilon to be much greater than the average change in volume, as this will indicate a spike. Formula 1 will be used to deduce if an increasing change in volume is relatively large compared to previous changes. This formula continually scales the changes, making the result only valid in relation to the adjacent timestamps. If the ratio between consecutive delta V bar results is greater than the average delta V bar, a comparatively large spike in volume has occurred. Similarly with price, Formula 2 will be used to identify scaled price increases. Allow g of t to be the price function. The price-result ratio between consecutive timestamps is compared to the average price results from the formula. Since a relatively small price increase is desired, we look for events below this average. When both volume and price events occur at the same time, the topic statement criteria are met. The formulas displayed on the previous slide are placed in Excel spreadsheets where a 2-hour time frame for each stock is analyzed. The step size between each timestamp is 5 minutes. On this volume data sheet of Cenovus Energy, we can see where the stock met the volume criteria. The column furthest to the right indicates if the volume criteria has been met. Here is the price data sheet of Cenovus Energy, taken at the same time as the previous volume data. The second column from the right indicates if the price criteria has been met. The furthest column on the right indicates if both price and volume criteria were met at the same timestamp. When this event occurs, the topic statement criteria are met and a price trend increase is expected to follow. This is a screenshot of Cenovus Energy at the corresponding time of analysis. The trend criteria were met at 12:10, directly before a further increase in stock price. 11 of the 14 stocks analyzed in this study met the trend criteria at least once. All 11 stocks increased in price 30 minutes after this event occurred. On average, the greatest price increases occurred 25 and 35 minutes after an event, increasing by 0.91% and 0.913% respectively. Here is a graphical representation of the price changes after the criteria was met. The average is highlighted by a thick black line. This is the same representation of the results on the previous slide, with only the average price change shown for clarity. Here is a bar representation of the results. Again, a thick black line is used to highlight the average. This is the same bar display of the results, showing only the average data for clarity. Further research can be conducted to see how price increase is affected by stocks in a specific sector or industry. Additionally, market capitalization may have an effect on the magnitude of the price increase. The time frame analyzed and the number of timestamps used in analysis could have impacts on the length of trend and present different exit strategies. This research has a very clear day trading application, and I plan on continuing and applying these methods to see if I am able to produce an even higher success rate through the use of added stock screeners.